Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into XPO Inc. Ticker is XPO.
And this one is fascinating. There's a really clear central conflict at play here.
Right. The whole investment thesis, it's a huge strategic bet on their LTL 2.0 plan. They're convinced it's going to deliver just, well, explosive operating leverage when freight volumes finally turn around.
And that plan is really driven by their proprietary AI tech and this massive capacity expansion. They've added over 2,000 net new doors during the downturn, which is key. Management is forecasting incremental margins north of 40%.
Which sounds amazing.
Yeah.
But that premium valuation is running right up against the wall of a, let's face it, persistently soft freight environment.
And the historical challenge of hitting a very aggressive LTL operating ratio target. So yeah, that's the tension right there. The massive promise versus the immediate, very real risks.
To really get a handle on how they even think they can hit those margins, you have to look at the architecture of the company.
You really do. And that story starts and ends with one person, Executive Chairman Brad Jacobs.
He's not just another executive, is he? He's more of a financial architect. This is the guy who founded, what, multiple billion-dollar companies?
7 of them. United Rentals, United Waste Systems.
Yeah.
His playbook is pretty famous. He finds a fragmented industry, acquires like crazy, optimizes everything.
And then he simplifies,
Yeah.
breaks it all apart to unlock the value.
Exactly. That's his whole strategy. Build the scale, then perform the surgery. And the XPO we see today is the direct result of that. They went through this very deliberate series of tripartite spinoffs.
Shedding everything that wasn't core to the LTL business. They basically built this huge logistics machine and then said, okay, we only want this one piece.
That's it perfectly. First to go was GXO, the contract logistics business, back in 2021.
And then came the brokerage.
Right, RXO in 2022. The whole point was to get rid of what the market calls the conglomerate discount.
The idea that investors just can't properly value a company that does too many different things.
So they undervalue the whole thing. By spinning those off, XPO became this pure-play North American LTL leader, just focused on moving freight. And, they still have the authorization to divest the European business, which just shows how serious they are about that focus.
So the stage is set, the simplification is done. But here's the real question. Is it actually delivering results right now? In the middle of this tough cycle. Let's look at the recent scorecard, Q3 2025.
The numbers show some really remarkable resilience, especially with the headwinds in freight. Company-wide Adjusted EBITDA for Q3 was $342 million.
And that's up year over year.
Up a solid 6%, yeah. And that's even if you exclude a non-recurring benefit from the prior year. And adjusted diluted EPS came in at $1.07. That's an 11% jump.
Okay, those are strong headline numbers. But the real story, the one that's supposed to justify the stock's premium, has to be in that core LTL segment. What does that pure play business actually look like under the hood?
It's absolutely the engine. The LTL segment's adjusted operating income was $217 million. That's up 10% year over year.
Okay, that's solid.
But here's the metric that every LTL investor lives and dies by. The adjusted operating ratio, or OR.
Right.
It improved significantly. It dropped 150 basis points year over year, down to 82.7%.
And 150 points during the trough of a cycle? That tells you something.
It tells you they are making real structural changes. You're not just riding a strong market. You are executing.
And part of that execution, which really stands out to me given the soft volumes, is their pricing discipline. Tonnage is down, but their yield just keeps climbing.
It's incredible. The pricing resilience is just, it's the core of the story right now. Yield, that's gross revenue per hundredweight without fuel, it was up 5.9% year over year in the third quarter.
Almost 6%.
And get this, you really need to pause on this fact. That makes it the 11th consecutive quarter of a sequential increase in revenue per shipment.
11 quarters.
11 quarters. This isn't just luck. This isn't a fluke.
No, that's a structural shift. It tells you they're being much more selective about the freight they take on.
Exactly. It says 2 things. One, after Yellow Corporation exited the market, there's been a rationalization of capacity so the strong players can command better rates. And 2, XPO is successfully shifting its freight mix. They're going after higher-yielding services, growing their local business. They are choosing better freight.
Okay, so this brings us to the absolute core of the investment thesis, operating leverage. The LTL business is an asset-heavy game. High fixed costs, all tied up in terminals, in the fleet.
And that's the crucial point. Those high fixed costs are a killer when volumes are low. They crush your margins. But the flip side is the massive reward potential.
Because the capacity is already there, it's paid for.
Right. The terminals, the doors, it's all in place. So when the freight cycle finally hits that
point of inflection.
Exactly. When volumes return, every single new shipment costs less and less to process. And that's where you get the explosive operating leverage.
Which is where that almost aggressive management forecast comes from. They are saying that when that inflection point hits, every incremental dollar of revenue will generate margins.
Comfortably over 40%.
40%. I mean, historically, for this industry, that sounds almost impossible. What gives them the confidence to put a number like that out there?
It's the payoff for everything they did during the downturn. They invested heavily in two things: capacity and technology. They basically pre-built the network for a surge in demand.
Let's talk about the physical side first, the capacity.
Okay, so they've added more than 2,000 net new doors to the network since late 2021, just steadily building out.
And a huge piece of that was jumping on the Yellow Corporation assets. That was a massive industry event.
A total game changer. I mean, in December of 2023, they didn't just buy a few properties. They purchased 26 prime LTL service centers and took over leases for 2 more.
And these are in key markets, right? Places where it's hard to build new.
Almost impossible. This is capacity their competitors can't get now. It dramatically strengthens their position for when the volumes come back.
Okay, so that's the physical network, the hardware. Now let's talk about the software that runs it. The kingpin, as they call it, has to be their tech. XPO Smart AI.
This is absolutely central to them hitting their targets. Management says it flat out. They expect the AI to drive 3 to 4 points of their overall Adjusted EBITDA CAGR target.
3 to 4 percentage points just from the tech. That's huge. Can you give us a concrete example of where it's making a difference?
Sure. Line haul efficiency is a big one. You know, the movement of trailers between all those terminals.
It's a huge cost center.
A massive cost center. They rolled out a new AI model that optimized their line haul, and it cut their empty miles trailers driving with no freight by 12%. And it reduced expensive diversions by over 80%.
So that's pure margin improvement right there. Fewer expensive third-party trucks on the road.
Exactly. And they're using it on the docks, too. AI for labor forecasting, for shift management. It predicts the freight flow and tells them exactly how many people they need for every single shift. No more wasted overtime or people standing around.
But this kind of build-out, the tech and the physical assets, it does come with costs in the short term. Investors need to see that on the P&L.
They do, and you can see it if you look at the salaries, wages, and employee benefits line. In Q2 2025, it ticked up to 41.9% of revenue.
Up from what, about 41.1% the year before?
Right, so you see that 80 basis point jump, and you have to ask, is that wage inflation eating away at the gains?
And the answer is?
The answer is that it's the cost of transformation. It's partly wage inflation, sure, but it's also a deliberate choice they made to insource more of their line haul. They're replacing expensive contractors with their own people.
Taking control of the network.
It's a short-term pressure on the P&L now, but it's what they believe they have to do to hit the ultimate goal of the LTL 2.0 plan.
Which is that long-term target of at least 600 basis points of improvement in the adjusted operating ratio.
That's the anchor of the whole bull case, that 600 basis points. It all flows into their long-term financial projection, which is to hit an 11% to 13% Adjusted EBITDA CAGR between 2021 and 2027.
And if they hit those kinds of numbers, the current valuation suddenly looks a lot more reasonable.
And to back that up, you look at their capital return plan. They still have a pretty substantial share repurchase authorization. As of the end of 2024, it was $503 million.
Big buyback program is a signal of confidence for management. It's a way to return value while you, the shareholder, wait for that cycle to turn.
Exactly.
Okay, so that's the bull case, the huge upside, the capital return. But we have to be disciplined here and look at the other side. What are the big structural risks that could derail this whole story?
There are 2 that really stand out. First, even with all their progress on pricing, they still have to close a pretty big yield gap with the best-in-class LTL carriers.
How big is that gap now?
They've made progress. They've brought it down from about 15 percentage points to 11. But that remaining 11-point gap is still a massive amount of money left on the table. It's an opportunity, but it's also a huge challenge.
And the second risk is a bit less quantifiable. It's a hangover from their old corporate structure.
Right. It's this ongoing insurance contribution litigation. It's related to some old environmental and product liability claims from historical policies.
What's the danger here?
The danger is uncertainty. In their own filings, they state that the potential losses from this are, and I'm quoting here, not reasonably estimable at this time.
Not reasonably estimable. Those are scary words for an investor.
Overhang on the balance sheet that can scare away more conservative money, no matter how well the actual business is performing.
So when you boil it all down, the investment thesis for you, the listener, comes down to this. Is XPO a high-risk bet on flawless execution? A bet that they can turn all this investment in assets and AI into that explosive 40% leverage the second the cycle turns?
Or is the foundation already solid enough? Have the 11 straight quarters of yield growth, the yellow acquisition, the AI, have they already built a structural advantage that guarantees margin expansion regardless of exactly when that inflection point arrives?
It's a timing versus execution puzzle. The next few quarters, I think, are less about waiting for volume growth and more about seeing if those operational improvements, that 150 basis points of OR improvement, are sticky.
If they are sustainable and scalable, that's what will prove whether that $500 million buyback is money well spent.
Risk defined, portfolio protected.